Futures falling sharply this morning after yesterday's relief rally as Credit Suisse is now on the ropes. This is what you need to know before the bell. We had a nice relief rally yesterday on the Fed's bailout of Silicon Valley Bank. And of course, now this morning, other ripples have arisen with Credit Suisse now on the ropes, down about 10% as their largest investor has now said they will no longer invest in the bank due to the drop in valuations. This is putting more pressure, of course, on the financial markets this morning. Currently, the futures on the Dow are down 575 points. The Nasdaq's down well over 1%, along with the S&P. And of course, the odds of a Fed rate hike next week, and particularly for the ECB, the odds of that 50 basis point hike are now completely off the table over concerns of financial stress in the system. As we talked about earlier this week, the markets took out that 200-day moving average on comments from the Federal Reserve on, of course, being more aggressive language on hiking rates to combat inflation. Of course, then over the weekend, we have Silicon Valley Bank. Markets rebounded on the bailout suggestion. That took us back to this resistance right there at the 200-day moving average. The markets are going to fail at that resistance level today, confirming right now, at least for the moment, that break of the 200-day moving average was serious enough to put the markets back into more bearish territory. Of course, that sell-off that we had last week found support right at those December lows. So again, now this December low becomes the next major support point for the market. If we break below that low, really kind of the next lows we're talking about go all the way back to October. And obviously we are back in bear mode at that point. Right now, the markets are confined to this range, but use any type of reflexive rally that we get over the next couple of days, reduce some risk or exposure until we begin to get back above those support levels, those previous support levels, and more back into bullish territory. That doesn't seem to be the case, at least right now, particularly as the Fed continues to talk about hiking rates, and we have this kind of financial stress now showing up in the system. Importantly, the rate hikes from last year have a lag effect. So if we take a look at the first rate hike in March of last year, exactly 1 year later, we have now this financial stress in the system. There's still 450 basis points more of rate hikes already done by the Fed that are still coming into the system. So the risk is clearly to a more negative market structured environment over the course of the next several months as we go through this. And again, while there's a lot of hopes the Fed will be cutting rates by September, remember that when the Fed is cutting rates, that is because they're trying to solve a financial or economically related event. Silicon Valley Bank and Credit Suisse may just be the first cracks in the surface of a bigger issue. I'm not saying that is the case, but it's something we definitely need to pay attention to as investors. So again, keep a watch on these support levels. The trend of the market remains in a negative trend ever since we got to that peak in early February when we triggered that sell signal. The sell signal is still intact. Markets are a little bit oversold enough here. We may get a little bit of buying support here around these lows from earlier this week. But again, there's not a lot of support there. So be cautious. And again, use rallies to reduce risk accordingly. I'm your host, Lance Roberts, and that's what you need to know before the bell.